Disclosing shocking warnings from financial expert Robert Kiyosaki and alarming trends in consumer credit, this video is an urgent wake-up call for your financial security. Is your credit card debt part of a more significant crisis? Make sure to stay till the end because I will unveil 8 banks at risk of failing. Section 1. Robert Kiyosaki's Alarm Bells. I recently stumbled upon an urgent warning from Robert Kiyosaki's Twitter account, the author of Rich Dad, Poor Dad. Kiyosaki is not just any financial guru. He has a track record of predicting economic challenges. And this time, he has raised alarm bells about the current state of the banking sector. He said, "Giant crash coming. Fake money, aka fist currency to die. Brux," which I think he meant bricks, "to put nail in coffin of fiat, fake money. Get into real gold, silver, and Bitcoin ASAP. Take care. End of fiat, fake money near." Kiyosaki is known for his straight talk and financial foresight. Remember, this is the man who predicted the 2008 financial crisis. So when he talks, it's wise to listen. He recently released a warning that should have all of us paying attention. He's talking about the imminent danger facing banks. In addition to this, a report posted on the Social Science Research Network echoes Kiyosaki's concerns. This report found that a staggering 186 banks in the United States are at risk of failure. So, why is this important? Because if these banks fail, it could lead to a domino effect that impacts the entire economy. And let's face it, none of us want to go through another 2008. That's just the tip of the iceberg though. There's much more to unpack here, and I will share it with you. Section 2. Consumer Credit Quicksand. Have you ever felt sinking when you open your credit card bill and realize you can't make the minimum payment? Yeah, it's no fun. What's alarming is that people who suffer from this problem are part of a growing trend. According to recent data, delinquency rates on consumer credit are on the rise. So, why are more people falling into this consumer credit quicksand? It's pretty straightforward. Everything's just so darn expensive. From groceries to gas, the cost of living has shot up. But let's be honest, our salaries haven't kept pace, have they? It's like trying to swim with a 50-pound weight strapped to your back. The economy feels the pinch when folks can't spend money. Consumer spending drives about 70% of the US economy. So, if we can't buy stuff, stores can't sell stuff. And if stores can't sell things, you can see where this is going. It's like a domino effect, but instead of falling pieces, I'm talking about losing financial institutions and maybe even another economic collapse. Section 3. Regional banks and choppy waters. A small fishing boat is sailing through an ocean storm, waves crashing over its sides, threatening to pull it under at any moment. Now, swap out that fishing boat for a regional bank, and you'll have a pretty good idea of what these banks are currently going through. Regional banks are in rough waters these days, guys. They're up against shrinking profit margins, higher deposit costs, and lower interest earnings. They've set sail without a compass and are now paying a price. And it's not just me or Robert Kiyosaki ringing these alarm bells. Moody's, one of the biggest financial services companies, has also reassessed its ratings and outlooks on these regional banks. It is significant. The weather forecast goes from light showers to potential hurricane, and many people are worried about possible downgrades. If you think this is all theoretical, think again. Remember Wachovia? Or how about Washington Mutual? Both were regional banks that bit the dust during the 2008 crisis. They suffered from the same issues we're seeing now: high deposit costs, poor interest earnings, and plummeting profit margins. Section 4. Unexpected vulnerabilities in established names. A report from the Federal Reserve reveals that nearly 1/3 of all banks have vulnerabilities lurking beneath their polished exteriors. Yep, 1/3. It could be more comforting. If you think these security weaknesses are limited to smaller, lesser-known financial institutions, you're in for a surprise. Even some of the most respected and well-known establishments are not exempt. Honestly, it was quite shocking for me. These are institutions that many view as highly reliable, akin to a long-standing marriage. However, just like in any long-term relationship, unexpected vulnerabilities can emerge, and these issues have financial experts concerned. Let's dig deeper into why these stalwarts show kinks in their armor. First up, wholesale funding. For those who didn't major in finance, wholesale funding is the quick and dirty way banks get money to operate daily. Imagine it like this. It's payday, but instead of getting a direct deposit, you must borrow money from a friend to cover your weekend plans. Well, these banks are relying too much on this, and when these funds are not readily available, they could end up between a rock and a hard place. But wait, there's more. Profit margins are shrinking faster than a cheap t-shirt in hot water. That means the gap between what the banks earn in interest and what they pay out is growing. And, as if they don't have enough on their plate, they're also being told to keep higher reserves, more cash stashed away for a rainy day. Starting yesterday, that's like finding out you need to save triple the money for retirement. So, what's the big deal for you and me? Let's break it down. If you have a mortgage with one of these banks or are making monthly payments on your dream car, staying on top of your expenses is essential to avoid late fees or penalties. If the bank starts to falter, who's to say your interest rates won't skyrocket? Consider that briefly. Your monthly payment could be unannounced when you least expect it. That's like planning a weekend getaway and ending up with a bill for an around-the-world cruise. When the banks you've put your trust in start showing signs of instability, it's like discovering that your trusted mechanic has skipped a few crucial steps during your car's tune-up. Section 5. The Fed's role in the rescue. Imagine the Federal Reserve as the financial world's firefighter, always on standby, hose ready. But what happens when the fires are too many and too big? Can even the Fed manage to put them all out? Robert Kiyosaki pulls no punches when he tweeted, "WTF? How can the Fed keep raising rates? How can the Treasury keep issuing bonds IOUs? How can Wall Street think the economy is strong? How can employees think their jobs are safe? Did these academic geniuses pay for their PhDs? Or did they get through school like I did, praying?" Provocative, right? But if Kiyosaki, a man who's been around the financial block a few times, is questioning the moves of the Fed, we should all be paying closer attention. With more and more banks teetering on the edge, there's chatter about the Federal Reserve stepping in to prevent an all-out banking collapse. It's like when you're watching a suspenseful movie and you're begging for someone to swoop in and save the day at the last minute. That someone, in this case, could very well be the Fed. How does the Fed plan to play hero? One option on the table is cutting interest rates back down to zero. That's akin to blasting water at the base of a fire to cool it off. Another approach could be quantitative easing. Imagine an aerial firefighting drop, dousing the market with liquidity by buying up government bonds and other assets. Why should we care about what the Fed might do? Because it's not just about the banks, my friends. It's about the whole financial ecosystem. Your job, mortgage, and retirement savings. If the Fed can keep the banks from toppling over, they're essentially helping keep our entire financial world stable. The idea of the Fed having to swoop in like some financial superhero isn't exactly comforting. But if that's what's needed to prevent another financial meltdown, let them roll out the heavy artillery. We'd all prefer a world where these rescues aren't necessary, but it's good to know someone has a plan, right? Section 6. The Unveiling of Vulnerable Titans. So you've heard the saying, the bigger they are, the harder they fall, right? Grab some popcorn because I'm about to unveil a list of banking titans teetering on the edge of a cliff. It isn't fiction, these are banks that people use daily. Okay, drumroll please. The 8 banks you might want to think twice about before depositing another dime are PNC Financial Services Group, PNC, SHF Holdings, SHFS, Citizens Financial Services, CZFS, Home Street, HMST, Western Alliance, WAL, ECB Bancorp, ECBK, PacWest Bancorp, PACW, First Foundation, FFWM. You might think, no way, these banks are too big to fail. But hold that thought. The data I've gathered paints a grim picture. SHF Holdings is trading at a measly 51 cents, losing 65% of its equity value this year alone. And get this, it has a 50% probability of financial distress. Why? It focuses on cannabis banking, which is a volatile area. Citizens Financial Services has a vulnerable balance sheet with a low cash-to-debt ratio. Don't let its equity gains this year fool you. Those numbers are only a part of the story. Home Street has lost 77% of its equity value this year and is also weighed down by a poor cash-to-debt ratio. It may look undervalued, but experts warn that it could be a value trap. Western Alliance is another name that has lost 54% of its equity value this year and has red flags like poor financial strength and a high debt load. ECB Bancorp and PacWest Bancorp have their share of issues. ECB Bancorp lost 31% of its equity value and has a concerning debt-to-EBITDA ratio. PacWest has lost 75% of its market value with vulnerabilities like a low equity-to-asset ratio and a high debt-to-equity ratio. First Foundation needs to be in the clear too. It has lost 68% of its equity value this year and has a debt-to-equity ratio worse than 83.62% of sector players, putting it squarely in the risky zone. These aren't your mom-and-pop community banks. These are giants with substantial clout in the financial world. And yet, here they are, wobbling like a Jenga tower in the final rounds of the game. You might be scratching your head now, thinking, where should I keep my money then? Fantastic question. Next, I'll walk you through bulletproof strategies to secure your financial future. Strategy 1. Know thy bank. Before you deposit your life savings into a financial institution, do your homework. What's their Moody's rating? What do their balance sheets look like? A couple of hours of research can save you a lifetime of regret. Strategy 2. Opt for FDIC-insured banks. Always look for banks insured by the Federal Deposit Insurance Corporation, FDIC, or a similar agency in your country. FDIC-insured banks offer a safety net for your deposits up to a specific limit, even if the bank goes under. Strategy 3. Consider online banks. Online banks often have lower overhead costs, which means they can offer higher interest rates. They also tend to have fewer fees. However, ensure they are FDIC insured and read customer reviews to gauge their reliability. If you found this video helpful, please give it a thumbs up. It helps me. Don't forget to share it with anyone who could benefit from it. Hit that subscribe button and ring the bell so you don't miss any of my future videos. And I'd love to hear your thoughts, so leave a comment below. Next, I've got another must-watch video for you, so stick around. Thanks for watching.